right, very excited to shoot this training video, this educational video for everybody with Kyle Wininger, VP of HSC, and Franklin Kincaid, our Senior Manager, to talk about a very important topic, which is ESOPs. And Franklin, we'll start with you. So exactly what is an ESOP?
So an ESOP is an acronym for an employee stock ownership plan. An ESOP is a qualified retirement plan similar to a 401k plan and other defined contributions plans that are subject to the requirements of ERISA. ESOP provides employees to share in ownership of the company, which is gained through years of service, in which shares of company stock are allocated to participants or employees' accounts. And ultimately, the vested value of the company stock in an employee's account is paid out at the time of termination or retirement. And so an ESOP is a means of providing significant long-term benefits to your employees above and beyond the short-term benefits already provided.
And so what are the advantages of an ESOP to a business owner?
From a flexibility and diversification standpoint, an ESOP allows business owners to take chips off the table, if you will. ESOP transactions can range from a partial transaction of 10%, 25%, up until 100% ESOP transaction. And typically, if you have a third party come in to acquire the company, they'll want to buy 100% of the employee stock or the employee assets. An ESOP allows the business owner the flexibility to phase out over time. Again, something that a third party may not allow. And then secondly, from a tax planning standpoint, ESOPs allow for more favorable opportunities to be taxed at federal capital gains tax rates rather than ordinary rates, which means ultimately the seller is going to walk away with more money in their pocket.
Yeah, I can see that. Now, are there requirements for an ESOP or parameters where it begins to make more sense for a business owner?
Yeah, that's a great question. And as far as parameters, we typically look at like four main criteria when looking for companies best suited for an ESOP. The first criteria is that the company's valuation is greater than $3 million. The second is that the company has a workforce of over 20 employees. Thirdly, that the company is not highly leveraged at the time of the transaction. And then lastly, that there's a good management succession plan in place.
Great. Thank you very much. So over to you, Kyle. Tell us a little bit about how an ESOP actually works.
Thanks, Ridgely. So how an ESOP works during the initial transaction is a trust is formed, and then the current shareholders of the business will sell their shares or their ownership stock to the ESOP trust. The shareholders are paid out immediately with bank financing for a portion of their proceeds, and then they also might take back seller notes or seller debt and get paid over time for that portion of their stock. Then once the transaction's done, shares are allocated to the participants, which would be the employees of the company, over time as a percentage of their compensation. Then as employees are terminated, they will be paid out for their ownership percentage of the company.
And how do you go about the process of valuing an ESOP?
Great question. The valuation for an ESOP company is extremely important. There's two times when you're going to get valued. One, the initial transaction, and that's to determine the value that the shareholders sell their stock to the ESOP trust for. And then there's also the second time is the annual ongoing valuation. And the annual ongoing valuation is to determine the value of the stock in the participants or the employees' accounts. The way it's valued, the standard of value is fair market value. So it's similar to what you would sell your company to an outside investor. And at the end of the day, the value of the ESOP for the transaction or for the participants is going to be based on future cash flows that the business is going to generate and present value that back into today's dollars, similar to a sale to an outside party.
That makes a lot of sense. Thank you. So Franklin, back to you. What are the main benefits of an ESOP?
Additionally, ESOPs are a good option and a possible solution for business owners who are looking for an ownership transaction, but they may not have been able to either locate a buyer or there's not a viable buyer available to them. Or those business owners who maybe not want to sell to an outsider or concerned about the impact on employees in the community if they were to sell to a third party. So definitely the ESOP provides many opportunities to a selling shareholder. But then from an employee perspective, there are also numerous benefits that ESOP provides. The National Center of Employee Ownership, or the NCEO, is a great resource out there for ESOP companies and those companies looking to potentially go an ESOP transaction. And through research, NCEO has concluded that companies who transition to an ESOP experience productivity increases up to 5% on average the year after an ESOP is adopted. Additionally, these companies also experience sales growth of roughly 3%. And employee growth overall of about 4% post-transaction. And additionally, the median hourly wage in ESOP companies was nearly 8% higher than non-ESOP companies. So clearly there's benefits across the board, both from a selling shareholder standpoint as well as employees of the company.
Outstanding. And let's look at the other side, Kyle. Are there drawbacks or downsides to an ESOP?
Probably the biggest is day one, we're going to leverage up the balance sheet. Because the selling shareholders is cashing out with either bank financing or seller debt. So the liability side of the balance sheet, we're going to put a lot of debt on the balance sheet. It is a qualified retirement plan similar to a 401k plan, but it is a little bit more complicated for participants to understand. There's a lot of benefits to the participants, but they do need to understand how that works since it's part of their retirement plan. And there's annual cost ongoing for an ESOP company. One, you have to have a valuation performed every year. Two, there's administrative cost. And three, there could be an outside trustee required to run the ESOP. Another drawback for an ESOP is kind of managing cash flows if we don't do 100% ESOP. Franklin mentioned earlier the possibility of doing anywhere from a 30 to 100% ESOP. If we do a 50% ESOP and we pay a distribution to the ESOP, there has to be a pro rata distribution to the other owners as well. So managing the complex capital structure could be another drawback for an ESOP.
And then how can Harding Shymanski best help the business owner to determine the merits and to create the ESOP?
How Harding and Shymanski can help the business owner determine if ESOP is the right succession path for them really starts with a conversation. What are the goals of the business owner? We really break that down into a few different categories. What are the goals for the business owners? Will this transaction get you in a place where you can live out the next chapter of your life into retirement in the manner that you want to? What are your goals for the company? What are your goals for your employees? And what are your goals for your community? Once we kind of determine what those goals are and determine if ESOP is an avenue that could make sense to meet all those goals, if it is, then we move towards doing the feasibility study to say, do the numbers support doing an ESOP transaction in this specific situation?
Excellent. And Franklin, finally for you, what is the impact on employees and what kind of culture can be created through the use of an ESOP?
Yeah, so the ESOP culture is so unique and there's so many benefits from going ESOP. Becoming an employee owner changes one's mindset. You're no longer working for someone, but rather now you're your own boss, if you will. You really control the future of the company. Employee owners, look for ways to improve the workforce, which ultimately drives production, cost downs, effectiveness, and as well as profitability. So employees and ESOPs begin taking an active role in the company, all working for one goal: the long-term success and the prosperity of the ESOP in the company.
Sounds like a win-win for everybody.
Absolutely.
All right, gentlemen. Well, thank you very much for the education on an ESOP. We definitely appreciate that and hope that this serves our clients and prospects to understand whether or not an ESOP truly meets their needs. Thank you very much to both of you. Much appreciated.